Hello traders, hello everyone, and welcome to our new video. This will be a free edition for today's update, actually for the end of the week. And finally, we have this US dollar reversal that we have been calling it since November, December of 2024, when we said that in January we could see a potential reversal when Trump will take office. And back then, as you know, we compared the Elliott wave structure with a free wave rise right into this 61.8% resistance, right into the time when Trump took office. So we compared the current situation with the one from 2016 2017, when we also have seen a top after the Trump took office. So now when we are seeing this pretty strong sell-off, as you know, this sell-off is mainly driven by Trump tariffs. Firstly, the US dollar has been recovering based on this tariffs plan, but now when some of the tariffs have been delayed and other countries, of course, are making their own new new policies regarding tariffs, then because they want to hit back, of course the US dollar has seen a pretty strong reversal to the downside. More importantly, this reversal has now impulsive price action. If you look closely here on this 4-hour time frame, what's the most important here is that obviously we have lower highs and lower swing lows, which is definitely means that at least at this stage we are in a downtrend. But whenever we are in a downtrend and we have a very sharp sell-off like this one, well, it usually suggests that because of an extension and very strong explosive move to the downside in a very relatively short period of time, we can label this as a third wave of an impulse, because in an impulsive sequence, okay, you will usually have wave 3 being the strongest and extended lag. So after a bounce, obviously we would then expect more weakness into wave 5. So I think that now we could possibly reaching the levels where maybe some stabilization could show up. Also keep in mind that we moved into this area from November when Trump won the US election, so all of the move has been now fully retraced, and that's why I think that maybe if we'll see some recovery, it will be only short term. Maybe we will get some recovery after non-farm payrolls report were released earlier today. The data came out 151k, but still nothing significant. We are not seeing any kind of a big move. So still, maybe the market will try to stabilize in the next few trading days. But whenever we get this wave 4, I would be looking for more weakness. Of course, there can be even more weakness straight from here, and then we will watch this same level as a retest of a resistance, and then we'll expect more weakness. So no matter how I look at this wave structure, I think that there is room for more weakness while the market is trading below this invalidation level. I also like the idea that we broke out of a base channel here, which is another indication how sharp the fall really is. So after rallies again at these trend lines, I think that fourth wave could again see a new reversal to the downside. So if you're looking for some opportunities, definitely fourth wave could be worth to watch. Also regarding the stock market, we have seen a pretty nice strong sell-off, but I can see some very interesting technical support levels here. So we basically retrace all the way back to this November levels here as well from 2024. It's called like a Trump level. So if we think that this could be potential end of a wave 4 flat correction right here, then that's definitely the area we should watch for. Okay, now what's important maybe to observe is also volume. Notice that we had seen some spikes in volume from 2023. Actually, there were two spikes that were quite significant here in March of 2023, so exactly 2 years back, then here in August of 2024, and now we have some increase in volume this week as well. And what this means, well, of course, in stock market, usually the sharpest moves will unfold when market will move to the downside. Because of fear, everyone will try to look for potential selling of their holdings, especially when you have such a big, when you had such a very nice strong move to the downside. But usually if this will move into extreme, you will see a spike in volume. But normally this extreme of pessimism can suggest that we are approaching the end of this corrective cycle. And this is also visible maybe through VIX, known as fear index. You can see that we are basically recovering quite significantly, quite nicely here, and now approaching these levels from last year, 2024. So maybe we are again in stage where fear could be at some extremes, and this suggests that potentially we are closer to support here. So what would this mean for the US dollar going forward if we really, let's say, we rally? Well, in ideal scenario, if the S&P 500 would rally and turn up from that levels, it means that the dollar index will continue to weaken with the US yields. Keep in mind that this is an old chart from 2 days back, but still it suggests that because of the dollar weakness, which is now already in full speed, I think that any kind of a stabilization, okay, on the stock market will potentially force even more weakness for the US dollar, because if stock market will stabilize and suddenly risk on resumes, there will be new inflows. So traders, investors will be selling dollars exchange for stocks. So of course, in such case, dollar could continue even lower. And what is really the most important at this stage, and based on correlations, is that we have lower US yields. Lower US yields mainly have been pushing to the downside because of some of the not so shiny, not so good, weak, not so good economic data from the US. More importantly, we have also seen a declining prices on crude oil, and as you know, lower crude oil equals to lower inflation, and lower inflation means lower rates, interest rates expectations. Especially when you have on top of that weak. Some weak US data, like we have seen in the last 2 weeks or so. So I think that US yields will continue to move to the downside, and I think that treasuries could be maybe even seen as a safe haven in some kind of a risk-off environment, but still think that US yields will drive the US dollar to the downside. And that's actually something the Trump administration also wants. They want lower energy prices and the lower US yields. I'm really not sure what should happen for US yields to turn higher, or Fed to turn out to be hawkish, because we clearly know that in this kind of environment, when you have stocks moving significantly to the downside, when you have some weak economic data, that's actually environment where rates, where Fed could be looking to cut rates rather than lifting them up, and this is something that will keep most likely dollar in this downtrend. Now, when it comes to dollar, of course, on the opposite side of this, we have euro dollar here. We see a very strong, significant rebound, and I've been calling this reversal for a while. We have now seen a 61.8%. That was a very important level. Some were calling for parity down there, but in fact, we are seeing the complete opposite reaction. And we know what was the COT data pointing out down here. We were basically seeing the extreme positioning on large speculators with similar at similar levels like we have seen back here in September of 2022, and if I'm not mistaken, even 2017 January, we have seen the similar values from large speculators. So of course, this data, the COT data months back, was pointing or suggesting that rather than we should be turning bearish, I saw the sentiment moving to extremes, suggesting that when everyone was so bearish on the euro, that we should be aware of the opposite. And now when we are seeing this very strong push to the upside, is bonds are moving significantly lower. We had the ECB rate decision yesterday. They cut the rates. They said that next decisions will data depend, but somehow they sounded a bit. They sounded like they want to be on hold. Okay, so they're not really convinced they want to cut further, meaning that this is something that can keep euro dollar here in recovery mode. Now, looking at this wave structure on the 4 hour time frame, again, very strong move out of a base channel. We are at this 161.8%. There you have very strong horizontal resistance around 109.35. So again, you're in the zone where some pullback could be really healthy, could be a really nice breather before the market resumes even higher. So whenever we see this pullback, I think that it's worth to keep an eye on this wave 2 land, okay, because it could be, whenever this wave 4 will start unfolding, could be very similar in distance. That's one thing. The next thing is that you should keep an eye on the 38.2%. But if the wave 3, the current one, will extend much higher, then maybe we'll not see a retracement for a wave 4 going back into the 38.2%, but maybe the 23.6 could be much more appropriate. That's usually the case when you have wave 3 very extended lag, even more than 161.8% of wave 1 measured from end of a wave 2. Okay, so after the next pullbacks, I think that there will be room for more upside. Now let's take a look also on gold. Gold is basically didn't move much this week, but you can see that I'm still observing and tracking this wave 4. We could be in the middle of a wave 4, and the reason is if that this wave 2 of the same degree, that's the length of a wave 2, and we are not anywhere near to this time projection. So I think that there will be more consolidation, but in the short term, if you try to zoom in a little bit here, if dollar will remain on the back foot, if the US yields will continue to the downside, this can keep metals in uptrend. I definitely realize that in such case, gold could even move back towards these all-time highs. And if you look closely here, this looks like a small impulse, while the current price action looks like a consolidation here. So I think that at least one leg here to the upside can be missing. Now, finally, let's take a look on Aussie versus Kiwi. The reason why I'm looking at this one, because I presented the short idea months back on the Aussie when we saw these 5 waves down and then this counter trend movement. And now notice that this counter trend movement didn't reach new highs. In fact, we are seeing a pretty nice reversal to the downside. And Aussie is looking very weak across the board. Could be something to do with tariffs that is planning Trump for China. So that's definitely something that keeps investors away from the Aussie, and maybe that's why Kiwi in general is much more attractive at this stage. And looking at the wave structure, we had a pretty nice and strong break below this channel. So I think that we could be targeting 1.1 in the near term, and then possibly we will see a stage where price could extend even lower back to this December lows. Invalidation level is definitely now here at 1.107. Okay, traders, I hope that you enjoyed this presentation, this video. Make sure to check our website as well, wavetraders.com. Join our community if you are interested in more of this analysis on a daily basis. And also make sure to be with us again in our webinar on Monday, where we will cover these markets more in detail. And of course, we will also look at some other markets like cryptocurrencies and some of the single stocks. Traders, have a nice weekend and talk to you soon.